FTSE 100, 250, 350, what the heck is that? Those were the questions that first came to my head when I heard of stock market indices. What the heck is that? I genuinely thought it was to do with football. Oh, how naive I was. And I bet you guys are wondering what stock market indices are about. Hi guys, it's your favourite YouTuber again, Danny Solari, and you're watching DS Learning Finance. Whoa. Simply put, stock market indices are a collection of stock companies that are categorically arranged together within one group. It tends to be ranked according to the market capitalisation. Quick maths. Market capitalisation is calculated by the number of outstanding shares of a particular company times by the share price at that time period. It basically tells you the value of the company within the stock market. For example, you have the FTSE 100, which is the top 100 biggest companies in the whole of the London Stock Exchange. The range for those companies tends to have a market cap above 4 billion or more. So if you see a company that has a market cap around that sort of ballpark, then you can pretty much guess that it is in the FTSE 100 basically. A FTSE 250, you guessed it, yeah, you guessed it, are the next 250 biggest stocks in the London Stock Exchange. These tend to have a market cap between 600 to 4 billion pounds. Need I say more about the FTSE 350, small cap and fledgling that basically follow after each other? It doesn't just stop at the London Stock Exchange, it actually transfers over globally. So for example, in America, you have the Dow Jones, which is the top 30 biggest companies in America that dominate the market basically. You're probably thinking, why is this important? Well, hold your horses. It's important because it tells you how big a company is. It tells you the dominance that company has, that stock has over the rest of the market. That's what it tells you. And that makes you money when you know how to read it really well. How? Why? What? That's probably what you're thinking. Oh, let's just look at the FTSE 100, which is the largest stock index in the London Stock Exchange. The largest companies in the stock market have very little room for expansion. Why? Because they're the biggest sharks in the sea already, so there's very little room for them to grow even further. On the flip side, you can say that yes, they're the big sharks, but then that means that they're really going to be steadier. They're not going to really be that affected by bad turns in the tide. They're not going to be that affected if the stock market isn't really doing that well. You can throw that point as well, and you'll find that those FTSE 100 companies, they tend to stand the test of time, so they will be steadier, they will be safer investments if you can call it that, but at a cost because the growth isn't as much. So you got to compromise between those two. When looking at the smaller companies, the roles are reversed. So the smaller companies have tons of room to expand. They can move from one stock index to the next one up. So they have tons of room to expand. This is your little fish in the big pond. Yeah, it's true that they can be taken out quite easily. That's definitely true. At the end of the day, they've still got years and years to develop and get bigger as well. So that's the sort of yin and yang aspect with small stocks in the small stock indices. Yes, there's awesome room for growth, but at the same time, they're very volatile. A bad turn in the stock market will ultimately mean a bad turn with that stock and potentially even bankruptcy. So you've got to outweigh the costs and the benefits. Is it worth putting £1 million in that risky stock when you can end up losing that whole £1 million, or should you be a bit more intelligent with it and maybe minimize how much you put in initially, maybe put in just 1,000 and see what that does? But yeah, it comes all in proportions with each other. Your ideal sort of portfolio is to have stocks spread across all markets. So not just the FTSE 100, not just the FTSE fledgling. You want your stocks to be spread across all markets in the London Stock Exchange and so on for your relative countries. You want that because it then allows you to have that sort of stability with the big dogs, with the big sharks, and also have that sort of room for growth with the smaller companies as well. Okay, cool, so I understand it, but how can it make you money? Well, as an investor, your dream goal is to make money, right? Yeah, self-explanatory. Okay, cool. And how do you make money when you're an investor? You make money by selling your shares for a higher price than what you bought them. Cool. So as an investor, your dream goal is to actually come in at the lowest point possible with a stock and sell at the highest point possible with a stock. That's how you make money in the stock market. There's no better way to make money in the stock market other than buying a company, buying stocks in a company that has started off in a smaller stock indices like the FTSE fledgling, and over the course of several years has entered, has accumulated, has progressed, has grown in stature to such a stage that they're part of the FTSE 100. That is every stock investor's goal, to invest in stocks that just do that. Why? Because it's like striking gold in the stock market. You would end up with profits several times the amount that you initially invested in that stock, if that were the case. Remember the quick maths I gave you guys at the start? Market capitalization equals number of outstanding shares times by the share price. So when you're going from a lower stock index to a higher stock index, what are you doing? You're increasing, well, that company is increasing their stock market capitalization. And how are they doing that? Well, it's because the company's doing really well, and therefore investors are buying in, and that therefore means that the share price will increase. So as you go from a lower index to a higher index, your share price will increase. So you're going from what you bought it from to a higher price, therefore you make a bit of profit. And when you keep doing that over several indices, so i.e. from the bottom to the top, you've made the maximum amount of profit that you possibly can make with that stock. That's why that sort of stock is every investor's dream stock, simply because you can make so much money from it. With that said, these type of stocks are very difficult to find, but once you find them as an investor, you cling to them. You don't let go, because those stocks will just keep rising and making you money. And the financial term for this process is called a breakout. Now, another thing you can actually do with these stock indices is you can actually invest in it. Yeah, you can actually invest in it, but the way that you do it is by treating it like it's a hypothetical stock. So it's not something that's tangible like a real stock. It's not actually something part of a company. It's just a hypothetical stock. It's a hypothetical thing. So the way you do it is by investing in that stock indices ETF, which stands for exchange traded funds, and that will mirror how that stock index behaves. And therefore, if it goes up, you make money. If it goes down, you lose money. This is really good for particular stock indices that you feel are booming. Maybe you feel that it's going to outperform the rest of the other stock indices. Maybe you feel it's going to even outperform stocks themselves, stocks from companies. So that can be a real big incentive to actually invest in an ETF, a stock market ETF. And that's basically why people do it. So ultimately, with stock market ETFs, you want to specifically invest in those that you feel are outperforming. This is all I've got for today, guys. I hope you liked this week's video and you know what to do. Watch out for next week's. But before you can leave, before you can go, you know what to do. Like, subscribe and share. LSSDS Learning Finance. Whoa. Bye.